Welcome back. Okay, Simon Conn is Investors Mutual small cap expert. So let's just take a look at where he sees value with Donald Trump doing a lot to make financials, healthcare, material stocks look more attractive. The bigger question is what companies here might be affected. Simon, thanks for joining us.
Thanks, Peter. Thanks for having me again.
Well, do you think that the Trump era is going to have any impact on A, the Australian economy, B, the companies that you go looking for?
Look, I don't think the Trump era changes a hell of a lot.
Say Trump or Trump?
The Trump era, look, he's not even president yet, so he's president-elect. And it's interesting, isn't it? Like, there used to be core and non-core promises. Well, this guy's made so many promises, it's hard to work out what's going to be core and what's going to be non-core. But look, fundamentally, at the end of the day, I don't think it makes a huge difference to the Australian economy. But obviously our share markets has been impacted, particular sectors have been impacted quite a bit by what we've seen in bond markets and the dramatic move up in yields over the last, last week or so. So that's played.
Explain to my viewers the kind of companies that you go looking for.
Yeah.
And the fund that you run.
Okay, so the QVE portfolio, it's a listed investment company, market cap of around $240 million, listed on the ASX, focusing on the X20 sector of the market. Yeah. So we're looking at stocks outside the top 20 for those companies that have the attributes we look for. So we're looking for businesses that have got a strong competitive advantage, have got a recurring and a predictable earnings stream to them, that are well managed, and that can grow through time. And all underneath that, a very strong value bias. So we're trying to buy businesses that meet those attributes.
Do they all have to be growth, or can they be dividend plays?
Look, I think yield and income is a very important part of the return you get from the share market. When you, particularly in volatile times like we've seen, I mean, the yield is one of those things that really supports the stock price if it might fall out of favour for whatever reason. And I think we've seen that playing through in the last week or so, where we've seen some share prices falling because they are sort of deemed to have been impacted by the sell-off in bonds, but they're trading at levels that make the yields really attractive, and I think people are gravitating to them.
So I know you're not an excitement machine generally, but are you getting excited by some of the prices?
Look, some of the utilities, and particularly Duet and Spark, where they've given very specific dividend guidance, have fallen to levels where I think it should have become really compelling. They're both yielding about 8.5%. And that, as I said, that's on the back of pretty strong guidance that they've given. They've got very predictable and solid business underlying them. Both are basically utility-type businesses. They run regulated electricity transmission or distribution businesses, and the regulated nature of their asset base means even if inflation was to be a lot higher, their earnings would reset, and they effectively get protection because of that. So they're effectively like an inflation index bond at the end of the day. So there's some inherent protection in there. I mean, the yields they're generating 8.5%, very attractive, particularly when the cash rate's still 1.5%, term deposits sort of 2.5%.
So, given that position of these two companies, do you think that there's been a bond market overreaction, and as a consequence these companies have probably gone down more in share price than they should have?
Look, I think the share price reactions of those stocks in particular strikes me as being a bit overdone. I think the bond market, yields obviously where they got to at the low point were, exceedingly low, and probably pushed artificially there because of the flight for income and the quantitative easing programs that we've seen in play around the world. And that really pushed investors into bonds, and in particular into infrastructure stocks who might necessarily not have been natural holders of that. As yields have gone up, they're now gravitating back to the bond market, really leaving some of these stocks a bit friendless in the market at the moment. But I think for long-term equity investors, they look attractive.
Now, my buddy and your boss Anton, at various stages of his life, has been a Telstra fan. The share price has fallen. The yields, I think Mike Kendall says, getting close to 10%. Now that's top 20, so
that doesn't figure in the QVE portfolio. I mean, we own it in the other funds, and effectively the yield looks quite attractive. But I think unlike a lot of stocks at the moment, there's not a lot of growth with Telstra, which is why we came to the market with the X20 listed investment company, because we think there are good quality companies outside the top 20 that can generate growth in this environment.
Okay. Let's go for a company that operates in America, and we know that we have a new president coming, Amcor. What's the story there?
Look, Amcor is a global leader in packaging, so it makes pretty basic products, and its earnings stream is pretty predictable and recurring. They make packaging, rigid plastics and cardboard packaging for a whole host of products, tobacco, you know, many of the Gatorade, Cokes and the like. And really, the nature of their business, it's a very recurring and a predictable business. Their operations, as you mentioned, are in North America, but they're also spread around many of the emerging markets around the world, through Asia, and that's actually one of the ways they're growing. Business generates fantastic cash flow, and they use that cash flow to fund, you know, a pretty healthy dividend stream. It's trading about 4.5% yield at the current prices, and also to fund accretive, sensible bolt-on acquisitions. And we've seen them over time make, you know, pretty good sensible bolt-on acquisitions through time. And the real key for packaging is that sometimes the nature of the product in the bottle doesn't change, but the packaging has to continue to change. And so, you know, Amcor can innovate and bring new product and help FMCG or consumer good companies bring products to market and be innovative in terms of, you know, their packaging solutions. And that really locks in a, you know, quite a strong position that they have with their customer base.
Is there another Aussie company operating in the US that you like?
Yeah, look, Ansell is a stock that, you know, we've talked about in the past. It's, you know, comes from the old Pacific Dunlop days. But Ansell, I always think of as being Australia's forgotten, you know, global multinational. It's a market leader globally in hand protection. So across the three categories they operate in, industrial gloves, medical gloves, and in single-use gloves, they have, you know, market-leading positions. They're number one globally, and that really underpins a very recurring and predictable business. And just recently, they've made some interesting upstream upstream investments where they've vertically integrated into the yarn manufacturing piece of a glove manufacturer. So for some of their industrial gloves, they're made from yarn, and then they put their coatings on the outside. Right. And this has really strengthened.
A more expensive product too, so a bit more value added.
Well, no, actually, what's happened is they previously outsourced that manufacturing to third parties, DuPont and the like. They've now taken that in-house, and it's given much more control over their R&D and their new product development. And it's also forestalling and preventing cheap knockoff copies of the products appearing in the market after they've sort of come to market with new innovative product. Okay. And it's actually seen the company recently announce a string of exclusive distribution arrangements with companies such as Grainger in the US, where they're now exclusively supplying hand protection equipment for those companies. And again, that's giving them more of the market in the US. So as you're alluding to with Trump, if there's increased industrial activity, there'll be more hands at work in automotive or in construction or in marine, and that will underpinning a level of growth for their business in North America.
Do you try to factor in the exchange rate when you invest in companies like Amcor and Ansell? Look, if so, what are you thinking on the currency?
Peter, it's always difficult with the currency. I mean, it can move around quite a bit. I think, you know, when appraising our investments, we always try and use a longer term currency. And 75 cents seems to be, for whatever reason, where it's trading now, but it seems to be a level where the currency gravitates through time. So, you know, it's hard to predict, you know, the short-term movements in currencies, but, you know, always try and take a longer-term view and sort of use a mid-cycle currency forecast.
Are there any sectors that you now like because of, you know, recent developments that were sectors you didn't like? Like, for example, I guess you've already alluded to some of these.
Well, I think, yeah, the utilities and some of the better quality REITs too, you know, some of those businesses that have got, you know, high levels of recurring earnings. So Shopping Centres Australia is a stock we own in the portfolio, and we've been happy.
How's it going? Because you've liked that in the past.
Yep.
And it had a bit of a dip, didn't it? Yeah,
look, it's trading around 205, 208, but at that sort of prices, you know, they gave firm dividend guidance for this year of 13 cents, so it's trading over a 6% yield for this year. So coming into the dividend season, December will go ex-dividend. So there's quite an attractive yield. With rates, I think still going to be relatively low for a longer period of time, in a lowish growth environment that we have in Australia. I think that's still attractive. The secret with Shopping Centres Australia is that a large part of their portfolio is leased to Woolworths. So, you know, supermarkets drive, you know, a fairly constant level of rent for them. And in their specialty tenants, the history of there is that they had to release that portfolio up quite quickly. They're now going back to market and finding that some of those portfolios have been under-rented, and they're able to increase the rents through time. So we think there's actually some growth there, just through initiatives under their own steam, and quite conservative balance sheet and conservative management.
What about the talk around Big W and Woolworths? Does that leave that company a little bit vulnerable if Woolworths try to close down their Big W stores?
Well, firstly, they've got long-term leases. They don't have a huge number of Big W's in their portfolio. I think there's only about 4, so it's not a huge exposure. And they are long-term leases.
You seem to know your stuff, Simon. Well done.
Yeah, well, that's what I get paid to do, Peter. We've got to know the detail, and I think that's what we pride ourselves on doing, and knowing the stocks. And
of course.
So look, in this current volatile environment, it's those things that have been sold off. So the Amcors, the utilities such as Duet and Spark, better quality LPTs like Shopping Centres Australia or Hotel Property Investments, and then being fortuitous and looking for opportunities that are thrown up. So a company we've liked, I've talked to you before about, is TOX, Industrial Waste Business. So business based here in Australia. So
TOX.
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 Yep. It's a capped at 400.
Is that its ticker code as well?
That's the ticker code. So it's it's a quality business, we think, in the small cap sector of the market. Operates really hard to replicate assets. They've got a suite of industrial waste disposal facilities. Yeah. Very hard to replicate them because people don't like to have a new toxic waste facility added to their suburb. And just recently they've made an acquisition of a company called Daniels. It gets them into the healthcare sector.
That's been around for a while, Daniels.
Daniels brand's well known. Yeah. And it has a strong market position in the healthcare market, about 20% market share. And as we both know, healthcare is a really attractive area to be in. And this is a way of playing that healthcare thematic. As the population ages and there's more people are having more tests done or more operations, that drives a level of waste. That healthcare waste has to be disposed of in a thoughtful way. And Daniels operates many of the high-end incinerators and waste disposal facilities that dispose of that waste.
Going back to Shopping Centres Australia, what's your view on retail? And are there any retailers you have in your portfolio? Because if you like the shopping centres, you have to have a reasonable view that retail can fight off a lot of the online challenges.
Look, retail it's always a tough sector, and you've got to really back good quality management. I think that's the key with retail, and we've seen good quality retailers over the time really differentiate themselves from the poorer ones. So we've got a small holding in Fantastic Furniture, which is fortuitously had a takeover bid from Steinhoff, so that's a good outcome.
And Julian
Tatani. Yes.
Is he causing trouble there? Or?
No, not anymore. Well, he's obviously going to be part of the Steinhoff empire. So they own Freedom Furniture, so obviously they're a natural buyer of it. Yeah. And the other retailer we own, we've got a small position in, is Myer. So we really like that.
But that's a speculator, isn't it? Because it's had a terrible run.
Yep.
It seems to be on the...
Well, we've got a really new management team there, and they're really reinvigorating the portfolio. Daniel Bracken, the feedback I get from the merchandisers, suppliers, is that he's a fantastic merchandiser and a really smart retailer. And Myer is really about shrinking back to core. I think they've got some really strong categories that they really do really well in, women's fashion and cosmetics, namely. And really it's about shrinking the store footprint and driving greater sales activity through that footprint and really driving up the return on equity.
Do they own much real estate? Because when the private equity they kind of kept the real estate. They sort of... Look,
unfortunately, that real estate was hived off some time ago.
Yeah.
But look, that's yesterday's story. I mean, it's in the price, and today they rent a significant part of. They rent their shops, and really what the trick is for them to reduce their footprint, so hand back space to the landlord, and then drive a higher EBIT out of their earnings out of their existing footprint.
Well, Simon, you did a great job, given the fact that I can't interrupt as much as I usually do.
It's unusual for you, Peter.
It's very, very, very unusual. But probably a lot of my viewers will actually like the fact that I've got a cold. I'm not interrupting as much, but some great content there. Thanks very much.
Thanks,
Simon
Peter.
Conn from Investors Mutual. Coming up after the break, we'll be talking to Marcel von Pfeiffer of Minius Capital. This is see what a hedge fund manager thinks of Donald Trump.